Hello, clients of Family Capital Management. This is Paul Damon, President of Family Capital Management. Hey, we're trying something a little bit new, different this quarter. Rather than having a quarterly update at a offsite location and inviting you to join us, we're actually going to bring the review to you. And this hopefully will allow more people to participate. It'll be a little more convenient. You can listen and watch this in the comfort of your own home while you're sipping a beverage or whatever you like to do while you listen to and learn about updates in the financial markets. So let's go ahead and dive in today. The first thing I'd like to talk about is what are the markets doing and how are things positioned in the overall financial market. The chart you can hopefully see on your monitor is the S&P 500 valuation measure. So the S&P is measured by the level of the price of stocks divided by their earnings or their revenue. And over the long term, you can see in the middle of the chart that the long-term average is around 16. That means for every dollar of earnings a company is generating, you're going to pay about $16 per share for that company's stock. And that's the long-term average. And right now, the current ratio is about 17.5. So what does that mean? Well, that means that the market is actually slightly overpriced or above the long-term average, not to an extreme, not to where we're very concerned, but certainly to be aware of and to keep an eye on. And this is something that we hear talked about quite a lot in the financial media. Economists and market analysts will talk about an expensive market or an overheated market or overvalued market. Those are all terms used to describe the reality that stocks may be a little higher than the long-term trend line. You can see on the chart also the huge peak back in 2000. The ratio got as high as 25 times earnings, or a 25 PE ratio. And shortly after that, if you remember, the market had a correction in 2001, 2, and 3, and stock prices dropped dramatically. By the way, you can see in 2009, the market bottomed around $9 per dollar of earnings. And so it was very inexpensive, and it was actually a great time to invest. But if you think back to that time, things were pretty shaky. There was a lot of volatility and a lot of concern about whether the markets would even survive, whether our economy would even survive. And so people were very hesitant to invest at all. And yet, if you did, you have experienced significant growth. The next thing I want to talk about is the forward view of earnings, the S&P 500. On this chart on the left here, you can see that the earnings of corporations are measured on a quarterly basis. And the fourth quarter 2016, while it saw a slight decline, actually still is quite high relative to the long-term trend line. And going forward, it looks like the projection are for earnings to continue to increase from here at a pretty consistent level. That's the green chart here, the green lines on the chart that shows the trend line is definitely an upward track. Over here on the right on our chart, again, some similar data where earnings the last couple years have been flat or even slightly negative. The earnings projected going forward appear to be a little bit more favorable, but not huge. We don't see a market where we're going to see a ton of positive earnings notations. And so really when we look at the stock market today, we feel like it's fairly priced, but not necessarily inexpensive. The next chart here shows, again, some numbers on the GDP. And GDP, again, looks to be on a fairly stable, positive trend. And so looking at where things are at today, we feel like the markets should continue to do reasonably well. We don't see any huge surprises coming our way or things that would cause us to have a lot of concern. We do want to continue to monitor the markets and be mindful of the fact that things can still be very volatile, and so we don't want to ignore that volatility and not factor it into our conversations with you. I've got one technical difficulty here I'm trying to work through. I need to get back my there we go. The next thing I'd like to talk about is the federal budget deficit. Something that we hear a lot of talked about today is the amount of debt we're taking on as a country. Certainly it's a concern to us, and I'm sure it's probably a concern to you also. And it's something that we definitely have to keep an eye on. On the left here on our chart, this page looks at the total spending. And while there's a lot of spending on defense, the largest percentage of our spending is entitlements. Over $2 trillion a year of the total of $4 trillion that we spend as a nation on our budget. Over $2 trillion is Social Security, Medicare, and Medicaid. And so this certainly is a concern because we've got an aging population. The baby boomers are getting older. And so healthcare costs are projected to continue to rise at a fairly significant rate. And with that, obviously, it presents a challenge to our economy. Certainly helps healthcare and companies like stock companies that are involved in healthcare, but it presents a challenge for our budget and the leaders of our country in terms of how to allocate revenue to fund all the things that need to be funded, including the social safety nets, defense, and then non-defense discretionary spending. Over on the right-hand side, it shows the federal budget deficits on the top right-hand chart. And you can see by the bar chart here that the debt levels peaked in about 2009. And that was shortly after the great economic decline of 2008 and 2009. A lot of money was spent to try to revive the economy and get things going again. And that money really was borrowed. We didn't have the money. There wasn't enough tax revenue, so a lot of money borrowed. That's now had a decline. So the trend line over the last 6 years has been an improvement. We're spending less, or we're borrowing less in our expenses as a nation. Looking forward, because of some of the things the current administration is talking about, there's actually a projected increase in borrowing, while not at a dramatic rate, certainly at a rate that continues to be a concern. You know, there's a lot of talk and discussion about long-term impact of the kind of borrowing that we do as a nation and what's it going to lead to. Right now, it does not appear to be a problem that would cause dramatic effect, but long-term, again, something that we have to keep an eye on. At this point, the deficit is growing at a slower rate than our economy and a slower rate than our tax revenue. So at this point, it's a manageable amount of debt, but certainly still something that needs to be watched very carefully. And the projections are right now, our total deficits are about 78% of our GDP, and that is projected to rise over the next 10 years to almost 89%. So again, that is a concern and something that we will continue to monitor for you and as we manage money in our portfolios. The next thing I'd like to talk about for a few minutes is unemployment and wages, two very key indicators of the economy, and one is an indicator and one is a driver. What do I mean by that? Well, unemployment is an indicator of how the economy is doing, and unemployment has dropped pretty dramatically. It was as high as 10% in 2009, and now it's closer to almost 4% or 4.5% as of February of 2017. So a significant improvement in the unemployment rate, which really, that's just an effect of an increasing economy or a growing economy. The other number here, or the other statistic, is the wage growth, which wages, there's been talk about the middle class kind of shrinking because wages haven't kept up with inflation. And so even though there's a growing economy and some people are benefiting significantly by that, some are benefiting considerably, and then the concern is the middle class benefiting, and the numbers here seem to indicate a slight upward trend finally in wages. And while that could cause some problems with inflation, it certainly could help to continue to fuel economic recovery. The biggest driver of our economy is still consumer spending, about 70%. So with wages increasing at a modest but comfortable level, that should help the economy also continue to grow. Inflation, I mentioned just a moment ago, inflation is a concern, always something to keep an eye on. The Federal Reserve watches it very closely. It's probably one of the more impactful things that we have to monitor. High inflation can be very negative. It can be very damaging to any economy. And so while we want some modest or low level of inflation, we certainly don't want to see high runaway inflation. Looking back at this chart, back in the 70s and 80s, inflation got very high, above 12% annually at a couple times. And you can think back to how bad things were then. The economy was shrinking. Things are in pretty tough shape. A lot of that was related to oil, and oil prices went up dramatically, the oil embargo, those kinds of things. But now we're looking at inflation that's, again, a very modest, a relatively modest 2 to 3%. And looking forward, that continues to be an area where we'd like to see inflation come in. Between 2 and 3%, we think, is a healthy level of inflation without it being negative or damaging. Because of inflation, the Federal Reserve is watching interest rates, and this chart shows you the interest rate from 1999 through 2017, and where interest rates are at today, and then where they're projected to be. So the current Fed funds rate is right around about 75 basis points. We are anticipating a couple rate increases this year. Depending on who you listen to, we could see anywhere from 2 to 4 increases this year. And so the projections by the committee itself are to end the year at about a 3% federal funds rate. The market is expecting a less than that, about 2%. So it's interesting that the Federal Reserve Committee is anticipating a little higher level of interest rates by the end of the year than the market is in general. And that, I think, is largely driven by the fact that the market does not believe that the economy is going to grow as rapidly as the forecast, and that inflation will not be as high as some of the projections by the Federal Reserve, and so there won't be a necessary need to increase interest rates to keep inflation under control. But we will see. The next looks at the markets and the volatility of the market and the unpredictability of the markets. Just a couple things here to take away. The middle line with the black dots and the line drawn connecting the black dots is a look at how a diversified asset allocation model performed over each year from 2002 until 2016, and then also year to date, so the first quarter of 2017. A diversified allocation through the first quarter was up about 3.8%. So that kind of gives you an idea. Last year, a diversified allocation was up around 8%. The year before, actually down around 2%. So that gives you a little bit of a perspective. The takeaway here to this chart for me is to stay diversified, to think long-term, and to not let the volatility drive your behavior, but to have a plan and a strategy to allow you to weather some of the volatility. The next chart is the flow of funds, and what there's a lot of information here that I'm not going to talk about, but what we do see is that investors are continuing to invest a lot of money in bonds, and that indicates to us that there's still quite a bit of caution because bonds are tended to be looked at as a safer investment than stocks, although stocks have finally increased. The flow of money into stocks has also increased since 2007. So we're seeing both stocks and bonds do fairly well as far as the flow of funds, and the S&P 500 continues to be one of the best places to invest and one of the favorite places for many investors. All right, well, that's what we wanted to cover for today. Hopefully this is helpful for you and gives you a little bit of perspective on where things are at in the markets and the economy. And our view on things is we're fairly optimistic for this year. We believe the markets will perform reasonably well. We don't anticipate outsized returns, anything outside of the normal 6 to 8% annual trend is what we're anticipating for this year. And going forward, most analysts that we listen to and follow are calling for somewhat modest returns in the stock market of 3 to 5% per year over the next 5 years. And again, some of that's just because of some of the things that have been going on for the last 4 or 5 years that have caused us to be where we're at today, where stocks are fairly or fully valued. They're not cheap in the sense that they're way below fair value and would be a great opportunity to put a lot of money, invest it, and take advantage of what we would say would be lower valuation. So we're not there. We're fairly valued, and in a period of like this, we're fairly valued with interest rates projected to rise and deficits projected to rise. We anticipate fairly modest, but hopefully consistent and somewhat stable returns. All right, well, thank you so much for your interest and your joining us today, and hopefully you had an opportunity to learn some things and get updated. If you have any questions about any of this or anything else, please, as always, give us a call at 774-4560. Thank you very much. God bless, and we will talk to you again soon.